In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about how RBI's repo rate changes company balance sheets and their borrowing behavior and what all of this really means for people like you and me. And in the second story of the day, I'll talk about how polluted air is not just a health crisis, it is also influencing the rise and fall of entire economies. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. See, every couple of months, the Reserve Bank of India announces its monetary policy. Now, at the center of that very announcement is something that is called the repo rate. Now, of course, some of you might be aware of it very well, but for the sake of those of you who are not, this is the rate at which the RBI lends money to banks. And while I know that this might sound like a very dry and technical detail at first to many of us, the truth is that this is a very, very important point in the world of finance. And I'm sure that if you have been a regular listener or reader of our episodes, or for that matter, any financial publication, you would have heard of this word repo rate quite a few times. But if you have ever paused to think about it, you might have wondered, what does a repo rate exactly do? And why does a number that is set by a bunch of people who are sitting in a room at the RBI have the power to move the entire economy? Now see, at a broad level, we already know that it matters. The RBI's own research shows that every time they cut the repo rate by just 1%, there is an immediate 0.09% bump in investment in the economy. Now I know that number might sound very, very small, but over time, that increase grows to over 1%. And in a country that is as large as India, that is a lot of extra investment. So the basic idea is that when a repo rate falls, interest rates across the economy also fall. And that makes loans cheaper for everybody, whether you're a business who's looking to expand or a family looking to buy a house or anybody else for that matter. Because the reality is, the more cheaper the loan is, the more likely you are to take it. This is called the interest rate channel, and this is one of the most well-known ways in which the RBI's decisions shape our economy. But that's not the only channel. Monetary policy does not just work in one single fixed way. It actually works through several overlapping mechanisms, and at different points in time, different channels become more important. Now, one of these is called the balance sheet channel, and it's the idea that the RBI is now digging into a little more deeply. They have basically studied how exactly this channel plays out in India, and the results are pretty fascinating, to be honest. So let's start from the very beginning and understand what the balance sheet channel even is. See, at this point, we all know that when the RBI raises the repo rate, the cost of borrowing rises, right? Loans become more expensive, and that's pretty straightforward. But there is a more subtle effect here as well. Now, imagine you're running a business and financial conditions in the country are getting tighter. Even if a bank is willing to give you a loan at the same rate as before, would you still be eager to take it? It turns out probably not. And that is because your decision to borrow does not really depend only on the interest rate. It also depends on your own financial health. This includes your assets, your cash flows, your net worth, etc. So if the value of what you own, which includes your land, your inventory, your investments, etc., starts falling down, even a loan at the same interest rate feels a lot more expensive. And that's when you begin to hesitate. And here is the interesting bit. Repo rate changes can actually cause your asset values to shrink. This idea was actually explored decades ago by two economists. They said that monetary policy is a bit like a black box. It does not really pull one lever. It affects multiple parts of the economy at the very same time. When the RBI tightens policy, yes, of course, borrowing costs go up, but that's just one side of the picture. At the same time, the value of assets across the economy also tend to fall. That includes stocks, properties, and other financial investments. A company's market cap drops, its share prices drop, its assets become cheaper, and in effect, the company's entire balance sheet starts to shrink. Basically, its net worth takes a very big hit. Now, imagine what happens after that. When a company's assets are worth less, it becomes a lot more cautious. Even if it urgently requires to invest in a new project, they might suddenly hold back. And at the very same time, banks look at the exact same company and suddenly feel less confident lending to it. Even if the company is fundamentally the same as before, it now visually looks riskier on paper. Banks then start demanding higher interest rates on stricter terms. So basically, for the same company, borrowing has suddenly now become more difficult, not because the RBI hiked any rates, but because the company now looks weaker financially. Now, this widening widening gap between the interest rates that strong companies and weak companies face is called the external finance premium, and that is at the heart of the balance sheet channel. See, so far, economists around the world have studied this channel in great depth, from the US to Japan to Eastern Europe as well. But in India, not that much work has been done on this part. That is the gap that RBI has now decided to fill. In a new paper, they studied how all of this plays out in the Indian context specifically. They basically analyzed data from about 800 manufacturing companies between 2002-2003 and 2022-2023. Now, during those 20 odd years, India saw 5 clear periods where the RBI raised interest rates to tighten policy. The researchers then asked a very simple question. When the RBI tightens policy, how do companies exactly respond? To get more specific here, they grouped companies based on two things. One, on how big they were, and second, on how indebted they were, which is basically comparing their debt levels to the assets that they owned. Now, they were particularly interested in something that is called the cash flow coefficient. To give you a quick sense, this measures how dependent a company's investments are on its internal cash flows. You can think about it like this. If you are a company and you want to invest in a new factory or let's say a new product line, you can either use your own cash or you can borrow money, right? Now, most companies would prefer to borrow, especially if interest rates are reasonably okay. They would rather park their cash somewhere else that gives them better returns. Now, this is particularly true for small businesses who usually cannot afford to invest large sums of their own money into new business lines. But when borrowing suddenly becomes harder, let's say when interest rates go up, this equation all of a sudden starts to change. Companies begin to rely more on their own cash to fund investments. So if you notice that a company's investment decisions are very tightly linked to how much cash it is generating, that suddenly tells you something that is very, very important. This means that external financing has become harder to access. So in other words, the balance sheet channel is active. Now, the RBI study found strong evidence of this. During periods of tight monetary policy, Indian companies clearly found it very hard to borrow money. So if they were still investing, they were doing it with their own pocket money. But this pattern reversed during easier financial conditions, which is when repo rates were low and loans were easier to get. Companies depended less on their own cash flows. And this is exactly what the balance sheet channel theory also predicts. But again, there were some more interesting details here as well, which all of us should also know about. See, this pattern was a lot more sharper in smaller companies. These firms are typically younger and they are still building out their core operations. They need to invest just so that they can stay afloat in the market. So when money is easily available, they are more than happy to borrow and grow. But when credit tightens, they just do not have a buffer. So therefore, their ability to invest suddenly becomes directly tied to how much cash they are making, because no cash means no growth. But that said, larger companies obviously behave very, very differently. The difference is that they have already invested in the basics. So when the RBI tightens policy, these firms do not necessarily have to scramble to invest using internal funds. Instead, they can actually afford to pause and hold on to their cash. If they do need to invest, however, their scale and reputation usually gives them easier access to credit as compared to other smaller companies. Now, interestingly, the RBI also checked whether a company's level of debt affected how it behaved. Now, you might intuitively think that a highly leveraged company, which is one with a lot of debt, would be more sensitive to interest changes, right? But the data actually did not show that. Whether a company had high debt or low debt did not significantly change how it behaved when interest rates rose. What actually mattered more was whether it could access new loans easily or not. So it was basically not just about how much debt you had already taken, but it was more about whether the current financial environment made it easier or harder to raise fresh money. So if you put all of these points together now, you will get a much richer picture of how monetary policy works in India. The repo rates do not just change the interest rates on loans, it affects how companies feel about borrowing, how banks access risk, and how business strategies are changed all of a sudden. Smaller firms, like I said, might feel the pinch much harder and usually have to slow down if their cash flows dry up. And on the other hand, larger companies can afford to take a much more measured approach, which means they can wait, watch, and step in only when the environment feels right. So in some sense, the repo rate is a lever that affects how confident businesses feel, how valuable their assets are, how banks judge their risk, and ultimately how much they invest in their future. In many, many ways, monetary policy through the balance sheet channel changes the entire financial posture of the economy. On that note, let's now move on to the second story of the day and talk about something that very, very quietly affects how we live, how we work, how we stay healthy, and how well an economy grows as well. This is the air that we breathe. And interestingly, the quality of that air is becoming a major economic story, not just an environmental one. See, while most conversations around clean energy and green transitions usually focus around climate goals, they are also very deeply linked to something that is more immediate, which is human health and productivity. See, the simple truth is that polluted air makes people sick, it cuts lives short, and it slows down economies. Countries around the world, including India, of course, are now being changed by this invisible force. So, this story today is about how air pollution is very quietly affecting global development and why it is now almost impossible to talk about economic progress without talking about the air. So, let's get back to the basics and understand everything from scratch in very simple words. See, most air pollution today comes from the very sectors that usually drive our growth. These could be power, transport, housing, and also food. Coal-fired power plants are among the biggest contributors of air pollution today. Coal is cheap and it is widely used, especially in countries that are still industrializing, but it releases large amounts of sulfur dioxide, which is a gas that causes respiratory illness and also acid rain. And to give you numbers once again, every year road transport adds around 34 million tons of these emissions globally. And it does not even stop here. Black carbon, or what is also called soot, comes from things like diesel engines and the burning of wood or charcoal in homes. In many parts of the world, especially in relatively rural or low-income areas, people still very much use biomass like wood and dung for cooking and heating, adding to both indoor and outdoor air pollution. Agriculture also plays a very important role here, especially through methane. Cattle rearing and rice farming produce about 139 million tons of methane every single year. Methane, by the way, is a greenhouse gas, so it is a huge concern for the climate. But it also leads to ozone formation near the ground, which affects both lungs and also our crop yields. Now, what's important to understand at this stage is that these are not fringe sectors. These are the core building blocks of development, which include how we produce energy, how we move around, how we build homes, and also grow food for that matter. And in this process, we release a mix of harmful gases and tiny particles that linger around in the air that we eventually breathe. These are called particulate pollutants, and they are especially dangerous because they can enter our lungs and bloodstream and could lead to long-term damage in our body. Now, the problem is that countries cannot just shut these sectors down, but the thing is that they do need to transform how they operate. So on that note, let's take a look at what air pollution actually does to people and economies. See, the human cost of this is enormous. Every single year, around 8 million people around the world die prematurely because of air pollution. Around 1.31 million of these people are due to indoor pollution from burning wood, charcoal, or waste. And the rest, which is about 4.7 million people, are from outdoor air pollution. Another about 5 lakh odd deaths are linked to ozone exposure as well. Air pollution is now responsible for 1 in every 10 deaths globally. That number is huge, and it makes it the second biggest health risk in the entire world, just behind high blood pressure. But if you think about the economic cost, it is almost equally serious. People who breathe polluted air fall sick more often, they go to the hospital a lot more, they miss work a lot more, and they just cannot contribute much to the economy. The first way this happens is through direct exposure, which is that people suffer from asthma, bronchitis, and other illnesses that reduce their ability to work. The second way is through microscopic particles that go deep into their lungs and cause heart diseases, strokes, and even cancer in some cases. Now, that means that people often die in most productive years. The third way is through ozone, which inflames lungs and reduces stamina over time. And all of this adds up to entire regions where people just cannot live up to their potential only and only because of the air that they are breathing. And this creates a very difficult cycle, especially for poorer countries. Most of them rely on cheaper fuels like coal or firewood, but these are also the most harmful ones. In countries where people earn less than $2,000 a year, access to clean cooking fuel is extremely low, and to give you a sense, it is often below 10%. So families have to breathe toxic air every day, children grow up with long-term health problems, and a lot of their money actually goes into healthcare as a result. These are the kinds of cycles that keep people in the space of poverty. Now, something strange about air pollution is that it tends to get worse before it actually gets better. I'll explain this. See, when a country begins to grow economically, it tends to use more fuel, it builds more factories, and it generally consumes more energy, which leads to more emissions. But history actually history shows us that this does not go on forever. When incomes rise, countries eventually invest in cleaner technologies and regulations. And this pattern, which is where pollution increases during early growth, peaks and then falls, is called the environmental Kuznets curve. The UK is a very good example of this. During the 1800s, London's industrial boom was powered by coal and the results were honestly horrifying. Some areas saw over 180 days of thick toxic fog in a year. Deaths from bronchitis rose more than tenfold in just 5 decades. At the very worst peak, 1 in every 350 people in London were dying from respiratory illnesses. But of course, over time, UK started introducing cleaner fuels, they passed regulations and also phased out coal slowly. And today, London's air is over 40 times cleaner than it used to be back then. But the truth is that turnaround took nearly a century to complete. But the good news for newer economies is that they do not have to wait so long. China, for example, managed to reduce its sulfur dioxide emissions by 75% in less than 20 years, even though it still uses coal. It did this by using pollution control technologies that capture harmful gases before they can even enter the atmosphere. The US is another success story here. In 1990, they launched a cap and trade system to regulate power plant emissions. Plants that polluted beyond a certain limit had to pay heavy penalties. And this forced companies to adapt cleaner technology, and sulfur dioxide levels, of course, as a result of it, dropped by as much as 80% in the next 2 decades. And if we think about sectors like transport, etc., the story is encouraging as well. In the UK, nitrogen oxide emissions are now lower than they were in 1950, even though people drive 3 times as much today. This was achieved through better engine design, through stricter rules, and catalytic converters as well. Also, since the late 1990s, pollution per mile has dropped by 85%. And today, electric vehicles are eliminating tailpipe pollution entirely almost. Countries like Rwanda are even mandating electric two-wheelers in cities to improve urban air quality. And China, which is one of the world's worst polluter, is now leading the global shift to electric vehicles and solar energy. In fact, China now produces more solar energy than the next 4 countries put together. About 25-26% of China's entire power today comes from wind and solar alone. The International Energy Agency believes that solar could become the world's largest power source within this very decade itself. So all of this brings me to India, which is the next major test case. See, currently speaking, we are at a very important point on the pollution curve where emissions are still rising, but our country also has access to the knowledge, technology, and the tools to change course. Every single person in India is exposed to safe levels of PM 2.5 particles, which are, by the way, the most harmful kind of particulate pollution. In cities like Delhi, pollution usually reaches extremely dangerous levels. On some days, the air quality index has gone beyond 450, which triggers health warnings and even work from home mandates in some cases. And since we were talking about economic costs here, the cost of this is also quite massive. In 2019, air pollution caused 1.67 million deaths in India. That's nearly 18% of all the deaths that happened that time. The economic cost was about 36.8 billion US dollar, which is 1.36% of our GDP. So if you think about it, if our air had met safety standards at that time, India's economy might have been 95 billion US dollars bigger that year. That is almost like wiping out the entire output of a large industrial state altogether. And it's happening year after year, every single year. What is even more worrying is that pollution in India is still rising right now. While China did peak in 2016 and then brought emissions down, India's share of global particulate pollution has still continued to rise. To give you a sense, from 2013 to 2021, India accounted for nearly 60% of the world's increase in air pollution. And still, only 8% of India's coal plants have the technologies that are required to reduce sulfur emissions. More than half of them have plans to install these systems, but the progress is honestly very slow. Projects are delayed and costs often run over budget. But all that said and done, there is obviously still some sign of hope. India is still among the top 5 solar energy producers in the world, and between 2018 and 2023, solar capacity in our country has nearly tripled. The government has committed close to 24,000 crore rupees to boost solar panel manufacturing. And if this is executed well, these efforts could help India sort of leapfrog the worst phase of the pollution curve. But again, that leap will not happen automatically. Cleaner air needs strong policy, smart investment, and also relentless focus on execution. The environmental Kuznets curve is not a guarantee at all. It is only a pattern that we have seen. Some countries make it through faster, others get stuck with high pollution and weak systems for a lot longer. What makes the difference is really how quickly and also seriously a country can respond. So if India can accelerate our clean transition, we will not just improve lives, we will also unlock growth, we will boost productivity, and overall, we will build a healthier workforce for our country. And if we do not, the economic cost can be huge, like I mentioned. The tools are definitely there. What is now needed is the will and the willingness to implement them, and also the urgency to act fast. Because, like I said, clean air is not just what you get after becoming rich, it is what really helps you getting there. That brings me to the end of the two stories of the day. On that note, let's move on to the final section of the day and talk about the quick news headlines. First, Reliance has acquired Kelvinator, which is the legacy home appliance brand, in a strategic push to expand its presence in the fast-growing premium appliances segment. With over 19,000 stores and a deep merchant network, Reliance now has the reach, and with Kelvinator, it is adding brand equity as well. Second, in one of the earlier episodes, we had looked at Foxconn's China troubles, from pulled engineers to blocked equipment, and now the industry itself is sounding the alarm. The India Cellular and Electronics Association, or ICEA, which basically represents giants like Apple, Tata Electronics, and Dixon, has written to the government flagging that India's $32 billion smartphone export target is now under threat. The reason is informal Chinese trade restrictions. Key capital equipment is being held indefinitely at Chinese ports. Skilled Chinese workers who are critical for final assembly setups are being blocked from traveling, and several Chinese suppliers have even cancelled India expansion plans altogether. Third and the final one for the day, adding to the steel saga that we have been seeing and talking about over the past few months now, India's iron ore imports are projected to rise to 8 to 10 million metric tons in 2025, up from 6 million tons last year, driven by increased demand from JSW Steel. Falling global prices, which are currently below $90 per ton, are making overseas purchases more attractive for the country's largest steelmaker. Also, if you've made it till here in the episode and you are a regular watcher or listener of our show, I have a very small personal announcement to make to you. I'll be taking a bit of a break from hosting Daily Brief for some time, and meanwhile, my colleague Akshara will be taking over. I will of course still remain on the back end of things and will continue to write episodes for y'all, but when it comes to hosting, I will be taking a bit of a break. So thank you so much for watching me and listening to my voice every day, and until I return, this is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.